Okay, so wanted to put this out with the video on my thoughts on this channel, Esoteric Trading Solutions, teaching crypto markets. This was sort of something we spoke about on Twitter with, I believe, Galgitron is his handle. So, yeah, basically my thoughts on this channel, on this persona, Suzie's her name, and so why I think that some of the stuff is inaccurate, and I have my doubts with regards to her, her financial background, and I'd like to point out some things. So I got my cheat sheet here. So basically, a couple of things. So some stuff doesn't add up, and maybe we can jump right into it. So let's go here. So I think she'll be talking about fund sizes now, and that's just awfully wrong.
Can vary anything from 100 billion to trillions. Okay, so you know they're going to see money come into this market. It's going to be huge. Banks have come out. Some of the banks have said that crypto.
Right. So fund sizes can vary from 100 billion to trillions. So multiple thousand billions. Now, if we look at the 25 largest mutual funds, one of them, so number one would be the SPDR S&P 500 ETF. So let's see how big that one is. Market cap, shares outstanding, where is it? Yeah, so total net assets 274.95 billion, 275 billion. So yeah, that's above what she suggests, right? She's speaking of 100 billion plus, so we're good. The thing where I have a problem is we don't reach trillions, so that's the first thing. So she gave a range of 100 billion to trillion, so we're at the lower end of her range, first of all. Second, this is an ETF, as you can see here. This is a ETF in admittedly the biggest market in the world, which is the US market, S&P 500, representing 500 stocks with the highest market capitalization. So that's totally off. What I'd like to show is a fund that's realistically big. It's one of the larger fund providers. It's from PIMCO. Sorry, it's not from PIMCO, it's from BlackRock, actually. So that's a fund that's been around for a while. So as you can see, launch date is 2007. So this is a fixed income global opportunities fund. So what you see here is, well, basically it's the performance and a couple of other things. So that's going to be basically a bond fund that prides itself in certain, whatever have you, approach to investing. So this is a typical retail fund, and we'll come to retail and wholesale, and she seems to be confusing things. But what I want to show is that that's an actively managed fund, because what she refers to, and biggest funds, and that's the distinction I want to make, active versus passive. So the fund that we saw before, the S&P 500, that is an ETF, so it's a passively managed fund. That's an actively managed fund. So this fund's been around for, 11 years? And let's take a look. So fund providers, BlackRock, day of inception, 31st of January 2007. And the total product assets are, well, close to 12 billion. 12, not 100, 12. In that particular asset class, that's the dollar-denominated share class, A2. which is an accumulating share class, so dividends shall be reinvested and not be distributed, has 771 million in there. And so that is a relatively successful fund, I must say. During my time at UBS, we used to distribute that. That was a product that was being pitched to clients within both advisory services, both discretionary and advisory services. So that's 12 billion for a fund that's 11 years old, and that's a success story. So it's just, I mean, I don't know where she pulls those 100 billion off, especially for the crypto space where there's so little there. I mean, relative to the global bond market, which is being traded here. Right. So this is a fund which is domiciled in Luxembourg. It is a typical European retail fund, accessible to the broad public. It is a UCITS compliant vehicle. We'll check out that, and it's a very typical structure in Luxembourg. SICAV, Société d'investissement à capital variable. So very straightforward, very standard thing. And that's 12 billion. It's not 100. Nowhere close. So that's the first thing. Yeah. The other thing, this is the professional wholesale market. Now, wholesale, right? Let me explain. So basically, there's two. If you look at it, her so-called institutionals, or she calls them instos, which is a bit strange. But maybe that's Australian. Usually it's insti if you. But okay, that's fine. So here it is. Generally, there's two markets when it comes to the distribution of collective investment schemes, aka funds. Or in general, there's two places money can come from. So one's the retail market and one's the institutional market. The retail market is often referred to as wholesale. I know it's confusing. It's not like a brick and mortar business, but it is what it is. So what are institutions? So first of all, institutions are not Fidelity, BlackRock, and so on. So while it is true that BlackRock and Fidelity do manage large amounts of money, they do not manage them for themselves. They manage on behalf of someone. And on behalf of whom, that's where the distinction institutional and wholesale comes into play. So a typical institutional client is an insurance company, a pension fund, and that's about the two major players that you can think of. Ultimately, an insurance company or a public pension fund will manage, money from people. But it goes through them, and they have a different mandate. So a public pension fund, they will have a certain mandate, so they will have to be able to pay out so and so much by then and then. So the demographic of their client base is relevant. But these players usually, they will do an in-house research. So California Teachers Fund, I think this is one of the largest. So they will, for example, they'll have their own view, most likely, on how much percent they should have in bonds and equity, and of that bonds, how much should be in high yield and how much should be in investment grade, and so on and so forth. And then if they've determined their what you call asset allocation, what they'll do is they'll go out and conduct a search. So they'll send out a request for information. So either they do that themselves, most likely not, they'll go through a consultant. And so you can think of that just like a headhunter. And they'll pay him a fee, and then that consultant will go out and approach asset managers such as BlackRock, Fidelity, Blue Bay, PIMCO, UBS Asset Management, Credit Suisse Asset Management, and all these who have subscribed to the consultants platform. And generally how that's going to work is that let's say that this pension fund that's on the search for, let's say they have determined that they need to increase their U.S. high yield position. They usually they'll go out sizes between 50 million or 30 million up to, yeah, I mean, a couple of hundreds of million up to billions. But yeah, that's rather large. Now the thing is that if there is an existing fund vehicle that, say BlackRock, for example, has, it's most likely going to have a pricing that's relatively expensive. So, plus, from a monitoring perspective, it might be easier to actually have a truly segregated account. So what's going to happen is that whoever wins that search after multiple rounds, and then they get to manage that money. And usually that money is going to stay in there for a couple of years, maybe a market cycle, maybe more, 6, 7, 8 years, depending. They most likely will set up a segregated account, and then they'll manage it for them, and then there'll be customized reporting, and it's also relatively easy to renegotiate the fees should there be an additional investment, so-called top-up investment, or should they redeem funds from this so-called mandate. So it's very unlikely that funds will go there. That collective investment schemes like mutual funds will be used in an institutional context. It does happen. Usually smaller institutional players will use that for different reasons, but generally I'd say the larger part is in segregated mandates. Now, what is the wholesale market? So now that we've covered institutional, what's this retail or wholesale market? So basically, private banks such as Credit Suisse or UBS, they will have a client base of relatively rich people, affluent people, these high net worth individuals, ultra high net worth individuals, and so on and so forth. And these people, they do not have this so-called house view. They do not have an idea of asset allocation. So who steps into place is UBS, for example. Let's pick that. I speak of them because I've worked with them, so I know how they function. So they will have their house view, which is basically a lot of analysts who are in the so-called chief investment office, and they will define for different risk parameters, they will define an asset allocation. So usually the place between how much equity and how much bonds do you have, and then you define, what kind of equity is it? Is it more European Monetary Union? Are you overweight the U.S. equities? Are you underweight emerging market equities, and so on and so on? And then also their sector plays are being made, overweight tech, underweight healthcare, and stuff like that. And so now what happens is that once the chief investment office has defined where they are overweight and underweight, the fund research team within the wealth management unit of the bank will have to search for products. And here actually mutual funds are being used, right? So there, a fund like this will come into place, so that's what's going to happen. So that is the wholesale or the retail market, which consists of having a fund manager, so an asset management company, a distributor, which would be actually the private banks because they distribute, and then there'll be the client, the end client, which are individual people who will have a couple of funds then in their portfolio to replicate the house view of the bank. So I thought I'd give that little heads up because there seems to be confusion here. I don't think that she really means the professional wholesale market here. And by the way, the concepts that I just described, institutional versus retail, it's not a European-only kind of thing. It's the US functions the same way. The difference might be in how funds are being distributed. Is that going through a financial intermediary, through local advisors, or actually through a larger bank? That is then local differences. The UK market, for instance, functions differently than the Swiss market, etc., etc. Right. Let's jump to the next one. 23.6. Let me see.
Of around 466 trillion. Anything from 250 trillion to 466 trillion, which is huge. The largest sovereign wealth fund in the world is the Norwegian Sovereign Wealth Fund, and considering they've only got a population of 3 million in Norway,
which is wrong. It's 5 million, but okay.
They've got a $1 trillion sovereign wealth fund. Now, all that money that they have came from petrol receipts. So the Norwegian government was very smart and set up this fund years ago to invest in other financial assets, whether it be equity, whether it be credit, whether it be hybrids, whether it be bonds or whatever, and put petrol receipts into this fund and invest in other markets. And now this fund is a $1 trillion fund, which is massive. So going back to overall, say if we said investment funds of the world was 466 trillion.
I don't know where she got that number from, to be honest. I have no idea.
Which is invested in equities, property, money market, fixed income, foreign exchange asset class investment. Half of that is a huge amount of investable funds. So even if we said half of that is going to be invested in the crypto market, that would be 5 times the amount of money coming into the market in terms of market capitalization.
Yeah, so that's a common mistake. So if 1% of investable funds came to the crypto market, so 4.6 trillion, right? So that's 1% of the above stated 466 trillion. So first of all, for the money to come in, I mean, at this point, it doesn't matter if it's institutional money from pension funds and insurance companies, or if it's retail money, which is coming into actually existing mutual funds. It has to be defined what is crypto. So, is it a security? Is it a currency? Is it a commodity? Before that, it's going to be very difficult to do that. In theory, the first movers into new asset classes is the retail market, interestingly though, and then come the pension funds and so on and buy those asset classes. A great example of that is senior loan funds. Senior loan funds are loans which are within the capital structure a bit lower, but they're still asset-backed, and their rate is floating. So LIBOR plus X, X being the credit risk that's been assigned to the company. And the good thing is about it, good or bad, the good thing is that the rate is floating. So adjusting with LIBOR. So basically you get that spread from the credit risk plus the LIBOR, which means the duration is rather low, around 0.3 or 0.4 years, which is rather interesting in a rising interest rate environment. And as a matter of fact, the rhetoric about rising interest rates came up in 2015 when the Fed, was slowly expected to start to tighten their monetary policy. And we at UBS, we started promoting a couple of products that actually did that. Now, today, 2018, interest rate risk, risk from rising is still a topic. It's very hard to get institutional clients, such as insurances and pension funds, to adopt senior loans. And it is very it's complicated. They're very conservative with that regard. They do not want to dip their toes into that. So what I'm saying is that what first has to happen is probably going to be a retail market at the very beginning, retail fund market, like that BlackRock fixed income fund that I showed you before. But for that, they need to go into fund structures, legal structures, such as UCITS or the US 40 Act. Both we shall revisit later. But you can't do that if it's not defined as a currency. As a currency or a commodity or a security or whatever it might be, because it's clear that what is an equity and what is a bond. So that's defined by the SEC, but we don't know. Okay, we know Ethereum is not a security, but what is it? It's a commodity. How should we treat it? So unless that's unknown, there's just no way markets are going to be set up. Funds are going to be set up. But the other thing is, and that is really a major red flag here, is that if you put in 4.6 trillion into a market, that doesn't put the market cap of it at 4.6 trillion. It's way beyond that. We know that you can push the market relatively easily, especially if it's thin. So investable funds of 1% is 10 times more than market cap. Yeah, okay, but you're not going to multiply the market cap times 10. You're probably going to multiply it times 100 or even more. Nobody knows, depending on the order book. But that's just a wrong way of thinking. And she is actually exposing herself as not very knowledgeable if she says that. Again, if you put into a 10 million market cap market, you put in a 10 million investment, the market cap's not going to be 20 million. It's going to be way above that. Yeah.
If we said that 1% of 466 is 4.6 trillion, and the market capitalization of the crypto market currently is 465 billion, you're looking at 10 times the market capitalization of the crypto market, which is huge. Which means there's so much money to come into this new market by the institutional guys, particularly as regulation comes in, custody accounts come in, all the...
Fair point. She says if regulations come in. Okay. Maybe she understands by that the SEC is going to say what is what's a security and what's not, and so on and so forth.
Exchanges are set up according to know your client, according to know the source of the...
I think that point's clear. Let's move to the next one.
Yeah, just make sure I haven't missed any of these. So these figures are really, really big if the institutional guys come in, and I believe they will.
Okay, so their portfolio could look something like this. $100 invested, 65% XRP, will want liquidity no matter what. Something that settles instantly with volume, does not work no matter what. Alright, 65% XRP. So, again, so there's two legal structures that investment funds are going to be set up with. And that is the US 1940 Act on collective investment schemes and the UCITS regime, which is pretty much a European scheme, European regulatory sort of framework. Switzerland is excluded, but they have their own scheme. And as a matter of fact, the majority of the funds which are being distributed in Europe are predominantly based in Luxembourg or in Ireland. Now, 65%. This would be illegal. And this is, when I see such things, I really know that somebody is not a financial professional. Let me show you why. For the US 1940 Act, so the Investment Company Act of 1940, there are diversification tests which must be met by mutual funds under this specific act in order to market themselves as a diversified mutual fund. And it says that 75% of the fund's assets must be invested in other issuers' securities. No more than 5% of the fund's assets may be invested in any one company. So 5% is the maximum, and the fund may own no more than the 10% of an issuer's outstanding securities. There's no place for your 65% number here. That's just awfully wrong. Sorry, but 5%, the investment company may not be invested more than 5% of its assets. Okay, it's in any one company. You might argue, yeah, but look, if you want to market a diversified fund, then you got to do that. So there's no way 65% of a fund will be in XRP. I mean, that would be such a massive exposure. You might as well buy it yourself. Because if you look at it, I mean, you pay the fund manager to diversify your portfolio according to certain parameters that, their risk management deems good. So there'll be considerations with regards to correlation, maybe, asset allocation, sector rotation, maybe some quant data, whatever have you. So if you are a believer in diversification, then you give your money to a fund manager, but then you expect it to actually be diversified and not have a bulk risk of 65% in there. So US mutual funds with 65% in one position, it's a no-go, and it's never going to happen. There's not going to be funds which are under this law, which are marketable to the broad public with 65% in it. So no US funds. Let's look at the UCITS funds. So this is from the ALFI, which is the Association of the Luxembourg Fund Industry. So we're spot on here. This is in German, but I'll translate it real quick. So US was 75, 510. Here it's the 510, 40. And so to diversify, it says that maximum 10% of the net asset value of the fund may be invested in securities of one single issuer, and all positions above 5% may not represent more than 40% of the total of the portfolio. So there's no way to get 65% in there. I mean, that's just here. That's the paragraph. All positions which are above 5%. So you can go above 5%. So you can have basically 8 positions at 5%, or you can have 4 positions at 10%. But you cannot have one single position at 11%. She's talking about 65.